Let me guess. You were the one that was bragging to all of your friends about how cheap your interest rate was, right? Well, you might pay for it in the future because interest rates are rising. If you open up any paper, I mean, who opens papers anymore? But if you open up a paper and read a headline, in the next 3 to 5 years, when it comes time for you to renew that mortgage, it could be a different story. So if interest rates are causing you anxiety and things are a little bit stressful at home, just stick around. I want to show you 7 things that you can do to help ease this anxiety that you might be feeling. But first, let's look at the problem, right? So on the screen, you can see that there is a purchase price of $600,000. So let's say you bought a house, $600,000, you put 20% down, $120,000, and you have a mortgage of $480,000. Now at 1.8%, smoking deal, am I right? 25 years, your mortgage payment would be about $1,900 a month. Now, if in 26, year 2025, 26, that same mortgage, if you were to do it again, there's a good chance, again, sorry, I should say that 1.8 is also variable. So we're going off of variable rates. That's a personal belief. I think variables are better, another video. But if we look at that same scenario, 600,000, 120,000 down, 480 mortgage at 4.4, your mortgage payment is $2,630. So nearly $600 to $650 more a month just because of interest rates increasing. So what do we do with this? How do we figure this out? How do you not just freak out and say, how do we afford this house in the future? But what can you do about it? So first off, tip number 1, increase your monthly payment. You may or may not know about this, but you are allowed to do lump sum payments to your mortgage. So sometimes it can be 10, 15, 20%, and sometimes they allow it once a year on the anniversary. But the other option is you can also just do extra payments on your mortgage. But let's say you did, I'm gonna go back here. Let's say you did get that $1,900 interest rate, or sorry, $1,900 per month cost of a mortgage, and you're like, well, if in the future it's gonna cost me $2,400 a month, why don't I just maybe do $400 a month now that is principal only? Well, that's going to pay down your mortgage, 1, a lot quicker, and 2, that's kind of preparing your finances, your monthly budget for what that cost could be in the future. All right, so that's tip number 1. Tip number 2, if you have high interest debt, pay that off, consolidate it, figure out a way to get rid of that debt. The thing that you want to do is you want to tackle that debt quickly because it's going to free up cash for when you renew your mortgage. Okay. So getting rid of that high interest, some of the bigger debt that you have, and attacking that is going to be really, really important. Number 3, creative ownership is what I like to call this. So what I mean by this is find a way to create other income streams from your property. So if it's just 2 of you and you live in this house, you got a finished basement, maybe you end up Airbnb-ing out a room to have some income, right? Maybe it's actually having a suite in the basement. Make sure it's legal. Well, leave that in your hands. But find a way, maybe a garage, rent out your garage, but find a way to actually have some income, extra income coming in to your pocket from the property you own already. And then here's like a little bonus tip. Do that, go back to number 1 and use that extra money and actually put that towards your extra monthly payment. Just saying. So that's tip number 3. Tip number 4, maybe you just have to choose a different home. Maybe this house really wasn't the best one. You really, overextended yourself. There are a lot of buyers, unfortunately, who do purchase right up to the top of what they can afford. And it's not what we love helping people do, but it happens, and it happens all the time. But what you can do if you have bought right at that threshold and interest rates increasing are actually going to hurt and going to not help you with financially in the future, maybe at that point, talk with your bank, talk with a real estate agent, figure out values, and also find what the penalty payments are. So right here, we got an IRD or 3 months interest payment. So these are the types of payments and penalties that you're going to have when you cancel that mortgage or change that mortgage. So find out what those are and put a plan together, because you might actually, it might be better for you to find a different house. Okay, so that's tip number 4. Tip number 5 is improving your credit score. Now, I am not a credit score guru, but I know people who are. And you want to talk to a financial planner, a mortgage broker. Those two types of individuals are really, really powerful and important when it comes to helping you figure out credit score. Sometimes that's taking out credit cards, using it, paying it off. Maybe you might have like open revolving accounts, you closing those off, paying them out, getting them out of your credit system, all those kind of things. Because what that's going to do is going to help you get better interest rates when it does come time to renew. Okay, so that's tip number 5. Tip number 6, we're rolling through these, is lock in at a variable rate. So many times, so many videos about interest rates are about locking in at a fixed rate, and we're saying the opposite. When interest rates are rising, having a variable mortgage is actually a great thing. And the reason is because it depends on the type of variable you get. And a lot of people don't like them and are a little bit not like them, but fearful of them, I guess. It's because, well, my payment's going to change every month. Well, there's actually one type of variable. The payment stays the same. And it's the, you can see my hands there. It's the actual interest and payment, interest and principal part of the payment that actually changes inside of your fixed payment. Now, this payment, let's just use $1,500 a month. If this number gets triggered and interest rates are going up, there will be an interest triggering rate that will make this payment increase, but then it just kind of changes inside here until there's another trigger rate. So it's one way that can actually be beneficial to make a switch over to a variable interest rate versus being in a fixed, unless you're locked into some crazy 1.6 fixed 5-year kind of thing. Like, that's insane. But if that's the case, I mean, that might make sense to stay there. But for some, this could be something that could really help you. And the last tip that I want to tell you about is consider using a longer amortization. Now, what that means is when it comes time to renew your mortgage, back in the day, there used to be 30, 40-year amortizations instead of the 20 or 25 that we see now. That might come back. That is something that the Bank of Canada, CMHC, they might be okay with bringing back. I don't know. But if they do, it could be something that you consider. And what that does is that brings down your payment every month because you're amortizing your mortgage over a longer period. So that is something to consider. But what I want to show you is, even if they don't bring back the 30 or 40-year amortization, I want to show you the difference of what it would be. Even if you, instead of keeping your 25 and then taking a 20-year because 5 years have been paid off, if you just stayed at a 25 instead of taking the 20, what does that look like? So here's our example again, right? 600,000, 20% down, 480 mortgage, 1.8. This is your 2020 bragging interest rate that you got. 1980 per month is is the payment, I should say. Now, if we look at year 5 on the amortization schedule, at the end of year 5, you're going to have about $400,000 left on the mortgage. So you paid down about $80,000 over 5 years. Okay. And so what that looks like is at year 5, you're not remortgaging or renewing with $480,000 of mortgage. You're actually renewing with $400,000 in mortgage. Make sense? So what that's going to look like is, if you took the new interest rate at 4.4% and you kept the amortization the same at 20 years, yeah, your payment's going to be $2,500 a month. So it's going to go up, $500 to $600 a month. That's very clear and very simple math. Now, if you decided to stretch that amortization and push it to 25 years and go back to the original plan, well, all of a sudden your payment goes up to $2,193 from $1,900. So now you're only increasing your monthly payment by about $200. So this is a trick that has been used a lot. I know I did it years back. You have to really be conscious of monthly costs. This could be a great way to do that. And it really, if you're making those extra payments, well then here's like a bonus tip. Do number 7 when you renew, and then do tip number 1, where you take an extra $400 and put it straight to principal. So pretend that now your mortgage is $2,500, like it would be if you're on the 20-year amortization like this, but you do this with a 25-year amortization, $2,100, pay $2,500 instead. Now you got $400 extra of principal going straight to your mortgage and paying it off so much faster. And that 5 years of amortization that you added or kept, it'll go away really quickly. So what I want you to watch next is this video. This video is where I dive in and we talk about rising interest rates and is that going to crash Calgary's real estate market? So go ahead, head over there, watch that video, and we'll see you guys on that video.